Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Jonah Bamberger. He is the managing partner and CEO of Aulder Capital. What do? They have the operational know-how with institutional investment experience. So what do? Execute value-add strategies for real estate assets. And we're talking about transforming underutilized properties into high-performing assets. Let's go. This is episode 243 of Zen and the Art of Real Estate Investing with my guest, Jonah Bamberger. He's a managing partner and executive chairman of Aulder Capital. Aulder Capital is a multifamily and hospitality value-add investment firm. Jonah, welcome to the show.
Thank you so much for having me, Jonathan. Really appreciate it.
We were talking about some good stuff in the pre-call, and I always tell everybody, we got to stop because we got to get this stuff on the air. But so how did you get started in real estate? There's so many things I want to get to, but I know you were involved in other high-end businesses and equity. What led you to real estate?
That's an excellent question. I started out in the infrastructure field, which kind of feels like real estate, just with a whole lot more complexity. You know, working for huge firms like the German conglomerate Siemens, 400,000 employees. And I think I wanted something more entrepreneurial, something that's a little bit for me. So I partnered up with an old friend who'd been at Lehman Brothers and then a group called Partners Group, always doing real estate, Brooklyn-based. And we kind of started out as a hobby. We enjoyed it. It was tough, but it was interesting. It was, we're talking 2012, so really caught the right time of that great financial crisis. And everything was on the up and up, and, 3 deals later and a couple of investors who wanted to join, friends and family. Suddenly it wasn't a hobby, it was a real job. And ironically, what actually made us turn it into a company and kind of our first hire and things is trying to deal with utility companies.
Oh, interesting.
When you're doing your own thing, you can end up on the phone for, 3 hours trying to get something out of an, Con Ed.
Yeah.
And this is where we're like, okay, if we're going to do this, let's just do this. And it's been quite a journey, 12 years, of course.
What were those first 3 types of properties that you bought before you started to add other people in?
The first deals that we did were, because my partner was Brooklyn-based and we liked Brooklyn, we liked the trajectory. We did a 6-unit in kind of South Slope, which is what they called Greenwood Heights, but they wanted something fancier.
I grew up in Brooklyn, so this is like right up my alley. And I moved back there 14 years ago, lived there 2 more years, but I grew up in Brooklyn Heights, so I love talking Brooklyn. And, because people think that Brooklyn real estate's untouchable, they don't realize how wide Brooklyn is and what you can do there. So this will be great for them to learn.
It's interesting, but I always tell people, especially around some of the projects we have now, Brooklyn by itself is about 2.9 million people. So it would be the 4th biggest city in the U.S.
Right.
New York is still the biggest. And if you take out Queens, that's the 5th. And I think New York is still the biggest. That's how big New York is. So, Brooklyn really runs the gamut. We did a second deal in Kensington and then another one in kind of by Bay Ridge. Each one of the deals was a value add, rent stabilized, working within the regulations, kind of coming in, something that was pretty tired and needed attention and love and care. And we really felt like we were able to give that boost. At the time, that regulation really created a lot of opportunity. Since then, it has changed dramatically to a point that it's simply destructive. But those initial deals where we were able to flip them, we caught the market at a good time. Each one of them held it for 2 years or thereabouts. Really strong returns, came in, did our business plan, moved on. And, between the construction and between bringing in new tenants and so on, it was, each one of the deals went from 6 units to 12 units to 25 units. And that was just kind of the cadence. And, suddenly the deal after that, we're looking at more and we had more appetite and investors, based on strong returns that wanted to come in with us. We only left Brooklyn once we felt it actually became expensive. And then ironically, we went to Manhattan, which at the time was Well, Brooklyn had so much buzz around it, and kind of those 2014-15 period, moved to Manhattan. And then when we felt like that was becoming overpriced, we really started doing kind of suburban garden style, which is really where we're more focused today.
Yeah. It seems that you've kept that kind of value add and turn proposition as you move to Alder, because you guys are really stabilizing, renovating some, but stabilizing and then turning them out, as that's what the investors really are looking for a lot of the times.
So what we find is that different, for us, because we're, we like the real estate space and we like what we do, we have dealt with very complex periods of time, everything from COVID, which was dramatic for people who, certainly in the residential space, it was dramatic, through what's going on now with high interest rates and just the complications around everything around it, insurance costs and so on. But we're pretty agnostic regarding whether we want to be a long-term hold or a short-term hold. It really depends on kind of who our investors are. By and large, we believe in transactional, deals. And I think that certainly in value add, you kind of want to come in, do your business plan, create that opportunity, and then sell it to somebody who's a long-term holder.
Right.
Sometimes we'll work with a group, a family office or a family that's got wealth, and they say, listen, we want to hold on to this for 10 years. Yeah. And we're okay with that as well. It creates fees. You're not going to make as much money as quickly, but over the long period, I think, your multiple obviously expands, and, and it's a steady business, which is really comfortable in some ways. You can kind of get to know an asset, you can work it. It can be a challenge in terms of capitalization, of course. Yeah. But over the long term, there's kind of advantages to each one of those plays, I think. So
yeah, and like you said, part of it is what the offering is to the investors and what the plan is, so you can stick to the plan. And if you do good at value add, you're going to have buyers when you're in the business, because people know, hey, you turn out a good product and they're looking for something turnkey. Like, that's perfect for those family offices. They just want to walk into something that's operational that will grow for them, but then you win and they win.
Absolutely. And I think that nowadays, we've been kind of 3 years into a very slow market where transactions are happening, but by and large, it's because of, maturity debt or rescue capital, so on and so forth. So anybody who doesn't have to transact is really kind of forced into an alternative business plan, or at least that's true for us.
Yeah.
And we're kind of biding our time and waiting because, that's the advantages of being able to control your own environment. It can be tough when it comes to debt maturity, of course.
Yeah.
To do a cash out refi nowadays, I'm not familiar with it, but
yeah. Well, I mean, but part of the scale of being a good investor on the long scale, especially doing syndications for for investors, is understanding when to put the brakes on the market and just knowing, hey, you know what, these deals just aren't going to match up to what our former deals were. And if we see a horizon where there's going to be better deals available, right?
Absolutely. And ironically, we've, over the time period, of course, we've made changes. We started out very Brooklyn based, but, like I said, Manhattan, stayed in the Northeast, went to the Southeast, always kind of chasing opportunities. And because of COVID in 2020, we actually even expanded to Portugal, where we do development. Yeah. Long-term rents in Portugal or Western Europe in general is not for the faint of heart, and it's not particularly for our appetite. But in terms of condo development and just a very aggressive market and, very, low competition, the debt, for example, is extremely accretive. Right now it's about 1.75 over SOFR for construction without a completion guarantee. That's incredible.
Yeah.
So you've got an attractive market, easy place to work. And because of what happened in COVID, where we kind of had to stop, we were looking for that opportunity. Now with interest rates being what they are in the US, that business has kind of, been a little bit more active, although it's a small, it's not a big market. So we don't want to overexpand there or overextend ourselves. There's, of course, different risks associated in general when you do this kind of development. But we also went into the hospitality space at the same time, kind of saying, okay, well, if multifamily is overpriced, things were, especially in the Southeast, 4 caps with, we just couldn't get it to pencil. In fact, we're still in that position where we find it difficult to find deals that are particularly interesting.
Yeah, I think there's been a couple year cycle of a lot of high-end buyers like yourself looking at like, okay, are these sellers going to get serious at some point? And they just haven't, but they're struggling. The sellers are really struggling, and everybody knows, what debt they're sitting on, or if they're pulling in extra debt. And a lot of them are, and those boats are getting full of water.
Well, what we've seen is that, we have good relationship with lenders, which I think is, if you want to be in this business, it's a very good idea, maybe even a requirement. And some of the lenders have reached out to us to see if there's a deal to be done after they've confiscated an asset and so on and so forth. And even then, it can be difficult because depending on which type of lender it is, they may not, the amount that they're already invested in may or may not reflect what we as buyers are interested, even though the original equity may have already been wiped out. They don't want to write it down necessarily, and they'd rather sit on it. So if you got some very, substantial groups that are typically lenders, they don't mind taking an asset if they have to. But that doesn't necessarily even mean that there is an opportunity there as a buyer.
Yeah.
And I think we have good relationships with some of these groups. And they say, okay, well, if you guys take us out at our loan value at principal, and we're thinking to ourselves, that's great, but that's not what the value of this asset is.
Yeah. And they're hopeful for a time frame of return, but a lot of times, we've seen things moving not the direction that everybody hopes. So I don't know if they see that same horizon. So maybe they get back to the table with something more realistic at some point.
Well, we've seen different types of lenders have different kind of pressure points.
Yeah.
A rent stabilized New York, which I don't know how many other listeners are familiar with, is pretty dramatic, just like a lot of heavy regulations are. Yeah. And it really wiped out a significant amount of capital or the equity in that type of real estate investment. So you had banks that collapsed because of it, or largely because of it. Entire pools of debt held by Signature Bank or now Flagstar. It used to be New York Community Bank, are really distressed. And what we find is some of the lenders there, they don't want to take it real estate owned. They're not willing to discuss foreclosure, but they are willing to sell it and write down a piece of their debt, of their position. And for us as, once that asset has been so dilapidated, there's no point, when the raiders come, they take it all. And for that specific regulation, we have a couple of legacy assets that simply we weren't able to hold on to them or weren't interested.
Yeah.
At the end of the day, we worked it out with the bank so that, it sold for a certain value and the bank took the hit. That having been said, I'm not convinced that the buyers that bought from us, they're in for a ride. Certainly they're at a very strong basis, but this regulation is draconian.
Yeah.
And it comes with that risk. I believe it's called catching a falling knife.
Yeah, I think that's a very apt description. And and some people are up for the risk, what's going to happen on the other side. But it's hard though. Was it hard for you to kind of move out of your core areas, knowing like, hey, we really know these markets, and then accepting, the numbers just don't work. We want to be here, but not for these prices.
That's a great question. We've always been, real estate is a micro game, right? So a place like Brooklyn has things that are super high end. I think you mentioned Brooklyn Heights. It's a very different environment and demographic on every front than, let's say, a more transitional neighborhood like Bushwick or Bed-Stuy, or neighborhoods that are not going to transition anytime soon, like, East New York or so on. So you've really got, even within such a small location, you've just got tremendous amounts of differences and, the walkability scores and which school district you belong to, and that can dictate how much rent is going to be and so on, to the point even that knowing which judge you're going to come up in front of in case of an eviction hearing and so on, or how insurance look at certain neighborhoods, which can be dramatic as well. So, for example, we always had an aversion to the Bronx, which is, has great neighborhoods, but because the insurance companies always viewed it so negatively, largely because the court system there is so averse, and we recognize that, and therefore we weren't willing to make that jump, as opposed to areas that are just much easier to work in, much lower regulations. And of course regulations, they keep out competition and they can create really strong fundamentals. Our assets today in New York perform quite well because there's no such thing as rent drops. During COVID, there was, I guess. But the good assets are fantastic, and they've just got these great fundamentals. And as a city, on the rental side, your supply and demand is so tight compared to, there's just so much more demand than what supply can be created. So, this is very different from some of the areas where even we've been. We have a significant portfolio in Myrtle Beach. And Myrtle Beach was overbuilt, and right now we're taking the hit on it. The rents are still higher than when we originally bought through the business plan, But occupancy is a challenge because until that supply is kind of, soaked up, it's a challenge.
Yeah, there's a few areas that are stuck in that thing where they overbuilt and then they halted, and now there's a lot of paused units, and everybody's wondering. I mean, eventually, of course, they're going to get built because people aren't stopping moving to these areas. But it makes sense that there's going to be a pause and a delay, which causes concerns on the rent end.
Yeah. Well, what's interesting is that, we've always done value add multifamily. So we've always kind of focused on the B class.
Yeah.
C class is a whole different animal. We do have capital A affordable properties that we own or manage. And I think that that's a really interesting regulation, although I'm far from an expert at it. But in the B class, you've kind of got strong, middle class families. So I think when things are built, largely they're built as an A class.
Yeah.
And really, it's the older A class that then turns into your A minus or your B plus. And we've always viewed that as a bigger challenge because if, the new property across the street has slightly more modern amenities and, in higher rents, then that's, you're going to lose your clients to that asset. That's where people can. And then it's hard to push rents on that one. We don't usually try to compete in terms of our rents with, those types of assets. Now, in areas where there's really tight supply, and we've seen this in a couple places, then you can do fine on it, right? We used to have about 1,000 units in kind of suburban Philadelphia. We were in a town called Yardley, which I don't know if listeners know. Great town, really difficult to build. So you can talk about whatever you want in terms of replacement cost, but you can't build there.
Right.
So, so our A-class asset was the A-class asset, more or less. And then,
and no one else was going to be able to get into that. It's a great point because I have talked about this before. Everything that's in the process of building, though, like you said, those are going to be A because they're trying to hit the big specter. So then those prior A's are in a weird spot also, but it leaves the high B's that we're trying to get to A and the value add also in flux.
Absolutely. Yeah. And that's always a challenge. Again, I'm an expert in the regions and areas that I'm an expert in. What we see is when it comes to new construction is by and large, if you're talking multifamily, it tends to be A-class. People don't usually tend to build to a B unless they're building capital A affordable, which is, of course, its own animal, right? So does capital A affordable create competition? I would argue not necessarily. It is additional housing, but I think it can, it's so limited and so difficult to get into it, then, I don't know if I've never been in a position where we've seen that that's the cause of reduction in rents.
Yeah. That makes sense to me too. Hey, it's Jonathan. I hope you're enjoying this episode with Jonah Bamberger as we talk Brooklyn. I was excited about that from the start. But if you're doing large-scale projects or if you're investing in other people's large-scale projects, one of the most important things you can do is to activate the tax benefits of cost segregation. If you're interested in getting a cost seg study done on your investment property, you can contact my guy, Sean Graham, at Maven Cost Segregation. Now, he's going to go through all the steps with you. We've had him on the show, and you can use my link at mavencostseg.com/green. And green has an E at the end. Let's get back to Jonah. How do you choose the markets? Because I know you go out of Brooklyn and New York, you're in Northeast, Southeast. Of course, we're going to get to Portugal because that's really interesting to me. Yeah. But how are you going about it geographically, picking new markets and identifying which ones might have the scale that you want?
Previously, we were also in kind of let's call it the Midwest. We were in suburban Louisville, Kentucky, with the same business plan. We went out, we acquired a couple of assets, about 500 units. And then we bought it in 2019, sold it in 2022, and kind of pulled back from there. By and large, because we're transactional, we chase yield. And I think that this is a bit of a challenge. And of course, this isn't for the faint of heart. This is, a lot of things people think it's, I can go out and manage this if it's far away, or this. You need to have a good, strong team, and you need to be able to do it at a scale that you're comfortable with. We've never been comfortable with things that are too small or too big. Too small in New York is very different than too small for garden style, of course. But by and large, because we chase yield, then we're looking for areas where there's less competition, where we think we have some kind of value add. Breaking into when you're good at value add multifamily, you can go into another region. In some ways, that's much easier for us than for us to say, try to get into logistics and warehouse where we really don't have the expertise.
Yeah.
And we felt like that would be a lot harder to break into. A lot of people, I have a friend who's based in Raleigh, and they own whatever asset class you want, as long as it's in that kind of RTP area, right?
Yeah.
Raleigh, Durham, whatever.
Yeah.
They'll do hotels, they'll do storage, they'll do warehouses, whatever you want. But they won't leave that triangle. We took a little bit of a different approach.
Yeah.
Thinking that, okay, if, we're better off, this is what we're experts in. We can go into a less competitive market and really bring in our expertise. Maybe a bit of it was hubris, it started in New York, and if you can make it there,
yeah.
How does it go?
Yeah, you can make it anywhere. It's different though. I mean, if you go from, what in Brooklyn or New York City, and then you just go to Kentucky, operationally, you guys probably have, hey, this is what our processes are, but you still have to work with locals there to get stuff done. And that's probably, one of the more difficult parts, I would think, and kind of getting into the community, figuring out what levers you can press and what's available, because it's not the same. It's not even the same from city to city, much less state to state.
Oh, absolutely. And your core team, we have a very strong local council in New York.
Yeah.
In New York, there are local council. When we go to a place like Louisville, Kentucky, or Myrtle Beach, South Carolina, we have to work with local council as well.
Yeah.
Sometimes it works very well together. Sometimes it can be a bit frustrating. The work hours for lawyers in Myrtle Beach are not the same as Midtown Manhattan.
Yeah.
Not to mention dress code and everything else you would imagine.
Yeah. No, I definitely know that firsthand. And it is interesting, but those are all adjustments that you make that honestly could affect your timeline, because small adjustments on a timeline can really affect a large scale value add that you expect to be a year and a half. Something that's going to cut off a few hours a day can have a large impact later.
Absolutely. And I think where we really try to, as we expanded, we by and large, we started in New York. I'll get it a little bit into politics, not too much, a very deep blue city with all the rents and regulations and so on that comes with it.
Yeah.
We've largely avoided our urban core because of that exposure. You can argue all day long whether Myrtle Beach is urban or not, but it certainly doesn't have the same dynamics as a city like Philadelphia or Baltimore, or Washington. We find that suburban, kind of that suburban infill, we've largely, except for our excursion to the Midwest, gone up and down kind of the I-95 corridor. So strong GDP growth, even if you don't necessarily have the same amount of population growth that goes with it. But, we prefer areas that are a little bit more regulatory light, that it's easier to work with. There's a lot of exposure to things that you wouldn't necessarily consider, everything from local taxes, school taxes, property taxes, obviously insurance, flood zones. We could go through a long checklist of things that, kind of buyer beware.
Yeah.
And we've gotten caught flat-footed on whether or not you need to have, a lifeguard at the pool during the 4 months that the pool is open. And suddenly that was an additional expense.
They're always looking to get the new people too. I mean, here they come up with these regulations for, hey, this 1916 regulation, you guys are in violation because you didn't have, 6 cones out in front when you had, backing up a truck or something. It's a welcome to the neighborhood type of thing, which I'm sure can happen.
Exactly. And sometimes it can feel, sometimes it beats you up a bit and you play nice with, with the community in the city. We do concessions in New York City. That's one of the things that we do. We've got a couple of concessions from New York City Parks and a few, and one large one with the National Park Service. And if you think residential requires playing nice, concessions is when you're in a public park and you have a venue going, just to have live music, you have to collect 2,000 signatures, and you really have to know how to work with those community boards. By and large, we work with local partners that are able to bring that.
Right.
That's not something necessarily that we do as investors.
Yeah, well, that goes to your guys' scale, because you said in the beginning, you bought these 3 properties, and then you realize like we not only can we not do all of this stuff, we don't want to do all this stuff, and now other people would like to invest money, and that's part of growing out and figuring out now what investments are still worth having the infrastructure of paying people to do it, even though you don't have to do that. The concession sounds crazy to me. Yeah, that would drive me crazy just even thinking about it.
I don't know. I'll tell you this much about value add multifamily. rarely do you get to one of the properties and say, I love this. You can love the people on the site. You can love the people you work with. You can be proud of what you're doing. We have, because we're a slightly larger group, then we've created an impact fund, a nonprofit. In some of our sites, we have backpack giveaways for the kids before school.
Yeah, awesome.
We do, healthy snack programs, things that I'm proud of.
Yeah.
Are they super impactful? I don't know. Sometimes small things can make a large difference, certainly when it comes to a community. Sometimes in the hospitality space, what you're able to do is something that creates a little bit more pride, something that just has a lot more foot traffic, so it's easier to host. It's, obviously we do this to make money.
Yeah.
But I think that doing something that you love and are interested in, there's a certain aspect to that as well.
Yeah, there's definitely ways to, especially with real estate and all the things we're talking about, where you can have a dramatic impact and sometimes it's smaller, sometimes larger, and also still make money. I think people feel like, oh, investors are only out to make money. There's definitely a way to do both. You have to do it carefully and learn over time what works for each area. But this is certainly something that you guys are focused on because you're thinking of these things in advance.
Well, value add, by and large, and this can be a challenge as well, right? But you're taking an asset that might be beaten up a bit, close to a slum, and now you're coming in. Some areas you're a housing provider, sometimes you're a landlord. I think we know what that means.
Yeah.
If you don't have the capital in an asset and it's, because of regulation, it's really gotten beaten up, then you could find yourself in the position of now you're the slumlord.
Yeah.
And I think that we've unfortunately found ourselves in that position once or twice because what do? You can't keep on pumping money into an asset. It's not how these things work. We're investors. We're not a not-for-profit.
Yeah.
So suddenly you can find yourself in the very difficult spot that you own a building that you don't want to own. This is very different, of course, than in an asset where you come in, you execute a business plan, you're rewarded for the service that you've provided and for, and people appreciate it. You've gotten some of the bad elements out of the asset.
Yeah.
And now you can really create a community. That's a much better business plan, a lot more pride that comes with it.
Less hassle.
I think if I would recommend, which kind of investing to do.
Yeah, but again, so you guys are yield, but your experience yield for new investors. Sometimes they're staring at yield, and a lot of times yield on the small scale is on these complicated properties. Someone says, "Oh, well, it's a D plus. I'm going to make it a C plus." One, you're not going to do that, and you don't know what you're getting into because, as you're saying, when you go in and you're going to transform any size of an apartment, not everyone's excited about it because the rents are going up afterwards. So they Absolutely. May be, very much against it and doing things to stop you along the way. And that's the first property that you're talking about.
Absolutely. Again, mostly coming out of New York as opposed to other locations, which simply don't have some of these dynamics. Yeah. I have friends who've had some real nightmare stories, and we've had some as well, tenants that don't pay rent for 6 years and you can't seem to get an eviction. You're just expected to support these people for their lifetime. I suppose.
That sounds like my experience in New York plenty of times.
Does it? So yeah. It took us actually one time, we're kind of still in the middle of it. We're 2 years into trying to evict a tenant that passed away. I don't know if that one ever happened to you.
No. My worst case was just like we were at about 8 months of unpaid. And we went to court. I'm an attorney. We go to court. It was, small scale court. And the judge looked at me and he just said, "They're trying." I'm like, welcome back to New York. Thanks. This is what I learned growing up. I did collections for my dad growing up in Westchester. So I was, very familiar. But it was just a different thing to kind of see it in person as an adult and be like, okay. And we did it, eventually it did work out. They were tenants for so long. It was just like, we had no choice but to eventually go there. But when you do that on a large scale, like you guys do, this is me, we had maybe 20 units around. When you have a building that has 200 units and 50 of those are in collections, that can have a dramatic impact on the ability to turn the place around.
It does. And, bad tenants make a building worse. I think by and large, almost any one of my assets, doesn't matter if it's our biggest one, I think it's 427 units. Our smallest one is probably 6 units, right? The larger it is, the more statistical your chance of you having. But a bad tenant can make an entire community worse. Yeah. And sometimes the best thing to do is to buy people out. We bought out a drug dealer. We issued him a 1099 for the payment. We had to dry out his apartment and the drug den above him. Again, New York.
Yeah.
and then for years afterwards, when we would run into him, it was very friendly.
Yeah. But that's part of knowing the game. You have to understand the game and what's the trigger for each person to get the job done. But have you guys found, one thing that I always say is when you're buying a property that's very run down, a lot of what can be problem tenants are really reacting to the prior bad management. So it's like the building wasn't taken care of, so they're mad. So when you come in, they don't trust you as a new landlord. And then you say, hey, we want to fix it up and raise your rent. So it's almost like their beginning point actually makes sense because it's been run into the ground. No one's fixed anything, but you're kind of left in the middle trying to please them and also make some money.
Absolutely. Listen, there's a big difference between doing value add multifamily than, Avalon Bay or some of these named communities that are kind of A++ service. And then just in terms of the happiness of the, of kind of the residents.
Yeah.
The term landlord, which in theory, I guess I object to because I view myself as a housing provider. But, that's an evil connotation, right? And in some places, that's kind of doesn't matter what the tenant does. They're always, the good guys and we're always the bad, right?
Yeah.
It's an interesting thing to kind of address because there is, as opposed to a restaurant where you want everybody to have the best experience possible, here that's not always the case, right? You have it, we're in multifamily. It's a value add. We're here to give a certain level of service that is worth a certain amount. Nobody goes to McDonald's and expects it to be, Tavern on the Green.
Yeah.
Right. Or maybe some people do. I don't know. Teach his own. But in housing, you want to be able to provide good maintenance, be proactive as well as be able to give strong response times. In some cases, people are crazy and you're not able to. We had, I could give all of my nightmare stories are in New York because,
of course, yeah,
that's the only place. But, when you go out to Myrtle Beach or to other places, you just have a lot more tools to deal with, challenging residents. By and large, and we spoke about evictions briefly, we always try to come up with payment plans. We always try to work with residents. But, people are...
It's better for everybody.
100%, without exception. And sometimes people, they can't meet the requirements and it's unfortunate and you do what you have to do. But, in terms of a community, there's no real reason to be the bad guy. If somebody, you want to increase rents by $100 and they've asked for a discount to $50, if it's a good resident, 100% of the time we'll agree to the discount.
Oh, yeah. So that's a great point, though. And that's a great point for brand new landlords, even if they're buying small multifamily, because I see a lot of people who, they'll be looking at a 2, 3, or 4 family and they'll say, oh, this tenant, they're $100 under, projected rents. And I'm like, they've been living there for 9 years and they also do the grass for free. Like, why? Just leave them alone. You don't have to renovate the unit. Their whole unit is old and they don't care. They just don't want anyone to mess with them. But it's the, social media and how people are telling you how to invest. So you got to get that extra $100 and then they ruin it, get a bad tenant. It's a really good point that I think is applicable to everybody and just understanding tenancies.
Absolutely. It's interesting, but the residents that you can work with, that you can, speak to, they will be patient with you. They will help you. The ones that are extremely aggressive, they will make your lives miserable. Yeah. And then therefore that's kind of where you want to sleeping well at night and being able to deal with, because some of these buildings end up in these very complicated positions. We have residents that cause damage to the building. And if you don't have cameras, it's hard to do. It's hard to catch. And then everybody suffers from it. And you kind of have to have different strategies for how you're going to deal with. And that's why when you have a good resident who you're friendly with, that's important. Yeah. That's more important than the extra $100.
Yeah, and P.S. that good resident that you're helping out is also going to be an information source on the rest of the building, which is I think is really important. But yeah, just knowing which tenants you need to get out and how you can get them out and what the impact's going to be on everybody else, then everybody else is happy. But yeah, it's not for the faint of heart. In case anybody hasn't figured that out, what we're telling you is this is not easy, and you have to build up the scale to build up a business of management, because it's just. Even when you guys were in the beginning with the 3, that when the last one was 25 units, it's just a lot.
It is a lot. Yeah, it is a lot, and especially when now of course to date we've had roughly 5,000 units, which is a lot. Yeah. We know very few of the residents, usually because of not positive things. But when we were starting out, we really knew everybody's name, and kind of what their story was. And silly things are, I remember our first real unit that it was rent stabilized. It had a high legal rent, but we could, there was a way to, it was really run down, renovated it, rented out to 2 people, ran a background check on them, which was perfectly okay at the time.
Yeah.
And we realized that I forget, one of the couple had been arrested in Texas for shoplifting. Okay, we let that one go. I believe they were both in medical school, just to kind of understand, you got to that level of detail. And then of course, as you get bigger, you can't possibly keep up with it.
Yeah.
But, being an entrepreneur, building it out, it's very different than kind of running a 6 unit. 25 units is already big enough that, there's constant turnover, there's constant leasing. And, when you get to suburban and you get to larger properties, I mean, it's even more dramatic. Our tenants, on average, the property will turn about 25%.
Mm.
So if you're talking about a 400 unit property, that's like a hotel. That's 100 new people every year. That is a lot of leasing activity.
Yeah, exactly.
And you want to have stable communities because turnovers are expensive, and you want people that are good residents. So, without a doubt, the right way to do it, I think, it doesn't matter if it's 4 or 400, you want to reach that level of stability. You want to kind of come in, do what you want to do with it, be gentle, take it easy, and then get it to a place where it's really running smoothly, because that's when you can now focus on what I always enjoyed the most, is doing the next deal.
Yeah. Again, though, that's something that even small scale investors, forget about, because they're trying to get, 4 or 6 doors to get started, and the stabilization goes by the wayside. They go from deal 1, they have some cash, they get deal 2, but, deal 1 needs an entire new, furnace for 6 units, and they're not counting that cost on that. Their CapEx, they're holding, $1,500 a month for that. And you're like, well, that's going to be 40 grand. You're not ready for that. But those are all lessons that you learn in multifamily. But something that we talked before we got on the air, I think is interesting for the listeners. You might be finding when you're listening to us that landlording's not for you, but there's another way to get into multifamily that I finally learned and got on last year. That's investing as an LP in syndications. And this is part of what you guys are out there offering as well, right?
Absolutely. And a lot of people, they come to us, and commercial real estate is very different than owning, a 3 unit or a 4 unit in terms of risk, in terms of appetite. There's people that like the bricks and sticks. And then there's people that really, they're busy. They have a life. They have, they have work. They have a family, whatever it is, and they want to put their money.
They don't want to unclog the toilet at 7:30 on a Friday night.
And it's always at 7:30 on a Friday night. It's
or
never
Christmas,
at 9
like
a.m. on a Monday.
Exactly.
And I think that's where syndication, that's kind of the groups like ourselves, that's what we do. We allow people access to different types of businesses. Sometimes, largely, I think we've beaten the market. Sometimes we don't. It really depends on what's going on. And I think that is part of, an investor and portfolio management. For people who have that type of appetite, you can really get that kind of exposure to these types of assets, which by and large perform well. They can be in a slower period like they are today, but that's also going to create a lot of opportunity. When everything was hot, it was a good time to sell. Now everything's cold. This is a good time to buy. This is actually the right time to invest, not the opposite.
Yeah, and it gives you the opportunity to invest geographically and asset class wise in things that you don't want to do on your own. If you're listening to this and you're like me, you don't want to be a landlord anymore, you still have the opportunity to be a participant in multifamily. You just can't adjust it, and it's going to be a little bit illiquid. But you can follow along with the monthly updates for the ride and learn a lot about multifamily, I think.
Absolutely. I think so as well. And I think good investor groups really, they're there to hold your hand, they're there to help you, and they love what they do. So they like to talk about it, which I think you can relate to as well, Jonathan.
Yeah. But I think you're right, though. I think that if we're just talking syndications, which I talk about a lot, and you're wondering like, hey, who's the best? The people who are really love what they do, they'll give you all the information. And then you say, you follow up with the monthly and ask for a call. Someone's going to call you back, because they're really into these deals and they know literally everything about the deal.
Absolutely.
If they don't, that's definitely a problem. But that's what I found. I found, as I was saying to you before, that it's important for me to have illiquid assets because it protects me from myself of trying to go and do something or, convincing myself one day, no, really, you want to do a 6-family on your own. I don't. Everybody told me not to. I don't like it. So being able to participate in, 50, 250 units and watch, maybe I learn a lot. And then later I decide, okay, I can do this on a smaller scale. I just think it's an opportunity that newer investors are going to look at a lot earlier than they may have in the past when everything was easy. Burr was easy, flipping was easier. Those aren't easy anymore. And they're not fun when you're doing them when you're new.
Absolutely. Well, it's interesting because we really started out the first one that we did, the second, the third, they were all kind of, this is a hobby. We all had jobs, we had things to do, and we loved it. We loved what we do. We still like the transaction, I think, more than the management. The management is how you make it worthwhile. Yeah. And we have a good team, but at least my passion is more with the transaction than it is with the, certainly with the day-to-day management, which can be exhausting.
Yeah, that's how I think about flips. When the flip's finished and I'm selling it, I love it. And I love the way it looks. I'm totally obsessed. And I kind of forget about every day that I hated every single second of it. But, that's the same too. Your management, you get through, do you do 100 turnovers, in a 3-year period? It's a lot, or there's, issues. But then when you get to the end and you realize like, hey, we stuck with our plan. We did what we wanted to. We pleased the investors. We pleased ourselves. You do forget about it. But the day-to-day operations, I think, for anything in real estate is a lot more than people know.
Absolutely. And I think that's it. Again, there's also a way to kind of buy some of these things and bring in external management. Yeah. I mean, we have a fairly robust organization, but when it comes to the concession business, whether it's, more on the hotel side or more, food and beverage and bar, that we take an operator. I don't want to, have to deal with, even the liquor license process is its own challenge, its own animal. So again, there's pride of ownership and I love to visit, but I don't want to be the operator.
Yeah, I read Unreasonable Hospitality and I was thinking that the whole time, like, this is a no-brainer, no restaurants for me. It's just too much. But I wanted to get to Portugal before we finish up because when you decided to go there, it was because things, it was pandemic when you decided to go to Portugal?
It was pandemic, right around then. And it was pandemic and we were, all of our U.S. assets we were managing. It was extremely challenging. I don't think we ever felt like it was the end of the world, but, it was definitely... there was a lot of uncertainty, and in some areas it worked out very well in our favor. 2022 was a banner year, just like many people. But we felt like this could happen again, and it did. It happened once interest rate, kind of came up, and a lot of our investor base is foreign, and therefore we had an opportunity to kind of bring them to a different destination. Yeah. Again, we felt that, we started out with accounting and legal, and those two things, regulatory aspects and understanding the tax system and things like that, that was step A, B, C, and D, right? Once we got comfortable with that, then we said, okay, well, how do we like this market? Is this something that has opportunity? Do people want to live here? And I think that not for nothing, it's been an adventure. It's such a pleasure to work there just because it's so unsophisticated that, contractors are contractors and problems are problems, but there's somebody to talk to and there's a way to work through things. It's old Europe. So the product that you're building is stunning, for lack of a better word. And you can really, you just really feel that you can come in and create a really good product and there's a ton of demand for it just because, they don't have that same robust industry of real estate the way that, you have in the US. Yeah. It's just less competitive. So you can really come in, carve out your niche where exclusively in a city called Porto, which is in the northern part. A lot of the people that come to Porto to retire are from the northeast of the U.S. It's a 5.5-hour flight. Yep. It's cheap, no matter how you cut it. And it's got public health care, which
is exactly where I was going. Yeah, so I've been looking at a ton of international real estate. I had Ladislas Maurice on, who's called The Wandering Investor. He goes all videos, and Portugal's obviously been a hotspot because there's opportunities for citizenship there that's a little bit easier than a lot of other places. So are the things what you have in Portugal, are those all rentals, or are you selling off some of those for these opportunities for people?
So we actually do 0 rentals. What we've got is we've got 10 projects. 9 of them are condo, or mixed use, but the bulk of
development
it is
for
condo.
sale. Yeah,
absolutely.
Yeah, that makes a lot of sense.
Your average Portuguese resident may or may not be able to afford it. Probably not. It's probably beyond their price point.
Yeah.
Keep in mind, these are smaller units, smaller family sizes, or retirees. So you're talking about, I don't know, let's say the sales price about $5,000 a meter. So it's about $500 a foot, maybe a little bit more, 600.
Yeah.
At the top end, maybe $700 a foot. So pretty cheap for what we're familiar with. Certainly not New York or Miami.
Yeah.
But that doesn't make it affordable for your average
Right.
Portuguese salary, which is going to be significantly lower than anything in the United States. So you kind of are going for that top end, which is great because you're building A-class condos and there's a lot of pride of ownership there.
Yeah, and it does help the infrastructure of the areas because it's going to bring in more tourism, more money, and more potential half residents to full residents, and then helps the property values overall to have those higher end comparables.
Well, ironically, every single thing that we've built, and it's always city center or close to it, we're buying these old, dilapidated buildings, some of which the bones are, they're old.
Yeah.
So the facade we keep, by and large. Some of the walls we keep, and they become like an artwork, like part of the project.
Amazing.
It's you keep this. We've got a project where the wall is 300 years old. I mean, you don't want to take that down. You want to bring that into your project. It's what makes the project so unique and beautiful. And we work with local architects, and it's been fun. That's actually one of my. It's relatively small in the overall thing that we do. You have to be careful because the regulations there can change tomorrow. Euro is its own currency. It's held up well against the US dollar, but that kind of development has also been a real pleasure. And the financing for it is accretive as opposed to in the US where we do financing. It's for construction, completion guarantees are scary.
Yeah,
interest rates are a totally different animal between the two markets.
Yeah,
so it's been a pleasure. The last one's a hospitality. We're building a hotel as well.
Yeah, I think when you go in and you're trying to keep the culture of buildings, which is how I flip as well, anything, just from a single house up, that shows that you care about the community. You're not coming in and saying, hey, we're going to knock down this 350-year-old building. You're playing with it, keeping the facade. I mean, I think that's really important to the people who live there because they know, hey, outsiders are building this, but is it going to fit into our community? Because for people who don't travel, you go to those towns, it's like you can't just, put up a Hilton or something. It just looks ridiculous.
No, and you wouldn't want to, right? I mean, you really want to kind of fit into the fabric. That's what makes it so unique and so special. Again, we talked previously in the call about local connections. We have a strong local partner. We have really strong local architects, lawyers. When you look abroad, I think you want to make sure that it's an area that, corruption is scary. Portugal doesn't suffer from that.
Yeah.
Anything that's too prone to, I don't know how to say it, but I guess confiscating your asset should be avoided. Yeah. You don't want to end up in something like that. And I think that's why we kind of found our sweet spot. We've looked at other places as well. We've looked at Greece. It's just very difficult to do business there. We've looked at England, which there's a lot of exposure to the economy, to the pound. I love traveling. I love London. But that doesn't necessarily mean that that's the right place for my hard-earned dollars to go. And all the more so when I'm working with investors and I have to tell them, it's my reputation and have that fiduciary responsibility to go to an area where, you might do great on the deal, but the currency might collapse.
Right.
Not a great idea. So
that's it. I mean, these are things that are really important for international investing because it's just not as straightforward as just investing in another state inside of America. Currency has a big play in how everything's going, economy, and understanding kind of the world landscape, who's near who, what's going to affect who in terms of that. I've definitely learned along the way. But Absolutely. That sounds awesome. I mean, I just know that a lot of people bring up Portugal because they look at it as a potential place where they could go live. So it seems like really the right spot, and politically, it's kind of set up to be in a good spot right now as well.
It is, and that was always our feeling. It's certainly for people who like to travel and they're comfortable. The language barrier. But again, when we do value add, we have entire properties and teams that by and large speak Spanish. So we've kind of gotten comfortable with different demographics and working and getting to know people and understanding what the requirements are. Myrtle Beach is interesting because nobody's from Myrtle Beach, at the end of the day, or very few people are.
Yeah.
Everybody's kind of coming in to retire, and it's a very different dynamic than, a long-term community where people have been living in the building for 30 years or 40 years.
Yeah.
Just two different things. And that's part of, I think, what we like about this industry is that we really get to learn and understand, and, there's people behind it. It's I've always viewed that positively.
Yeah, and that's part of diversification of areas, asset types, and asset areas where you can at least, that to me makes it more fun. I get bored easily. So everyone says, riches in the niches, but if I do the same thing all the time, I will get bored. It may still make money, but then I have to step out of it. But that's why I think the Portugal thing is cool, because it is something you can learn from. It's also more enjoyable because it's different and there's more relationships to build and make. And then you see where it goes.
Absolutely.
Yeah. Awesome. Well, Jonah, it's been a pleasure. Is the best place for people to find information about what you guys do at Aulder.com, which is AULDER.com?
Absolutely. And there's all of our information, and anybody who has any questions or wants to learn more about us, we're always available. We love what we do. We love to talk about it. So please reach out. Feel free. And Jonathan, thank you so much for having me. It was a pleasure. Love these discussions.
Absolute pleasure for me too. I'm glad I got to sneak in a little Brooklyn talk as well, because that always just makes me feel better about my heritage. But yeah, I really appreciate you spending the time, and it was a pleasure talking all things investing and a little bit of international investing as well.
Absolutely.
All right. That was Jonah Bamberger. He's the managing partner and executive chairman of Aulder Capital. Again, you can find them at Aulder.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And this is an energy episode, so you need to be ready. Episode 244, my guest is Jessie Lang. She started investing in real estate by house hacking more than 10 years ago, and we are going to talk all about how she did it, grassroots, 36 months, 11 doors to 70 doors. She did some the wrong way, she did some the right way, but she's been focused on the BRRRR method. She's going to bring it back. I can't wait for you to hear this show. We'll see you next episode.